Well, it gives me great pleasure now to bring on board on ET Now, Mr. Vaidyanathan, the man of the moment, to talk about how things have transpired for IDFC First Bank for the quarter gone by and what lies ahead. The year 2023, in a sense, will be remembered as a year where markets really realize the potential of this franchise. The stock has been one of the best outperforming stock in the entire financial space. So what's the way forward after another quarter of solid growth? Mr. Vaidyanathan, you've ticked all the boxes. If I look at the growth, top profit growth 30% plus, deposit growth 30% plus, NIM growth 30% plus. So 30% seems to be the new normal for IDFC First Bank. But my question is that as you grow, your base also increases. Can you maintain this run rate of 30% plus for next 3 to 5 years?
Very interesting that you brought in a new angle of 30%. Really, we didn't think about it like that. The way we think about it to looking ahead, we think that a loan growth of about 24-25% is what we guide for. We think that's very much achievable even for this year. And profit and deposits, by the way, as soon as a foundation for any bank, because that's the raw material. The really good news for a bank, this raw material that's growing thick and strong for the bank, that's up like 44%. So I think this is very much sustainable for the rest of the year. If not 44%, let me say 40% is looking, the route is very clear to us.
So how will you manage to beat the base effect? Could it be because of the pure expansion of the book? Or you think it's the tailwind in the sector which is so strong that at your base managing this kind of a number is not a problem despite the high base?
It's not a high base, first of all. When you see the big banks, like, the big four banks, they are running deposits of 18, 20 lakh crores. Our deposit base is only like 1.6 lakh crores now. So we feel that we are relatively a small base. And for a small base to sprint ahead at this rate is very much possible. So basically, since a branch network has rolled out, our brand image has become very strong. Nikunj, actually very, very strong. Of course, not in the league of the big four, but let me say it's quite strong. So a good brand, good product, a good corporate governance image, all that will bring deposits. We feel confident for the rest of the year. And incidentally, we dropped interest rates to just 3% for less than 1 lakh rupees. Money was flowing so thick and fast into the bank.
The net interest margins remained steady at about 6.3%. They were steady at a time when peers have reported a drop largely because of the interest rate curve. Going forward, now that interest rates are becoming benign, what happens to your net interest margins?
We feel it will be stable for the rest of the year, Coach. We don't see a major problem with that.
And do you see on the deposit growth also the 40% growth what you just referred to because of the brand you've built, the customer, the number of satisfied customer, you will be able to grow your deposit base at 40% given that there is still a war of liabilities in the Indian banking sector?
That's what I was pointing out. At least for this rest of this year, things look quite clear. We feel confident for the next year also. 24-25 also we feel confident about sustaining a strong deposit growth. Because even in 24-25, our base will still be small. I think there is a base effect working in our favor and base being low. And I think for the next 4 or 5 years, our base will continue to remain low when you compare to the big banks. Then probably things will stabilize. And frankly, we don't need deposit growth at 40% after 2 or 3 years. Because since a loan book growth is only 22 to 25, you don't need 40. You need the 40 only for 2 more years when we are going to pay off those legacy infrastructure bonds. We need to honor that and we need funds for growth. So this 40% need is only for a couple of years.
The way I look at IDFC First Bank trajectory is that first it was in repair mode. Now it is in growth mode, and now the benefits of operating leverage would kick in, which is that sooner than later your cost to income ratio will start coming down. That will fill up your profitability going forward. When do you see that big turn happening? 2021 was repair. 2022, 2023 was about growth. Now perhaps the benefit of scale and size should come in when it comes to things like cost to income ratio.
Yes, very much actually. The first 4 years, 3 years, let me say, we've been here post-merger close to 5 years now. But let me say the first 3.5, 4 years are repair only actually. But last 1.5 years, we are feeling very strong on the foundation. Let me say we built the foundation. On this foundation, we're feeling very confident to grow the loan book by 24, 25 and grow the deposit by, the numbers we talked about. When you look ahead, the key thing on cost to income is that actually even this year itself we were expecting some sort of a dip, but as you know, interest costs went up in the system overall by a meaningful number. To that extent, our interest cost went up, and therefore the cost income ratios, etc., all these things got affected because when you have cost to income, the income you take net income, net of interest cost, so it got affected. So by next year, let me say by exit quarter of 25, we should see a more meaningful reduction. And 26, 27, 28, you can see that, this story will play out very well. I just wanted to remind you that we have like 5 years, converting from a large DFI to a bank. So in that sense, the progress has been pretty swift at the bank.
One chink in the armor, if I may say, fly in the ointment is still ROA. It is not way below your guidance, but it is still below your guidance of 1.4%. When will that surprise factor kick in?
Definitely, it will improve in due course. I can't claim it will increase every quarter because life, business is the business, and one quarter can be up and down. But when you take year on year, when you take 24 over 23, meaning 23 over 22, 24 over 23, 25 over 24, 26 over 25, the bank will see continuous increase because we have set a very core model. As you know, we are not hurrying it up. We are playing this game in a very safe and stable manner. And when you play in a safe and stable manner, sometimes you take time, but it becomes more sure. That's the approach we have. But you will see year on year, you'll see improvement now. And by the way, it's moved out from literally from zero, like 0 to 1 in 4 years. It's pretty healthy now, and we feel better.
No, it is healthy indeed, but the growth what you've reported in a sense are making markets and your shareholders perhaps hungry for more. That is the spirit of the market. So my next point is that you've raised capital in the quarter gone by. Banks, when they're growing, yes.
No, I said that's the spirit of the market, but it's my job to calm down everybody and not to get too excited. And we are playing for a steady innings, for a long innings, and I really request people not to expect miracles, not to expect that quick work. Bank is doing a steady job, and steady and sure job is much better than quick and whatever.
How much importance, honestly, do you pay to the stock performance? Because for banks, when they're growing, they need capital. When they need capital, they tap the market, and which is what you've done. So in the overall scheme of things, for any growing bank like yours, there is need of capital, which in a sense is serviced by equity raise, and for that you need a good price. How much importance do you pay to your stock price?
See, the way we look at it is that if we do the fundamentals right, somehow the markets do recognize that. If you notice today, even today, our return on equity is not that high really compared to many of the peer banks. We're still on the build-up stage. But market is valuing us relatively better than a return on equity today. So we do believe that a safe and steady job with a clear picture thrown out for the future, markets do appreciate that, and it is reflected in us. I agree with you, but the more important thing is that we are well capitalized at 20%. That's very important. Our capital adequacy is running at 18%, so we are well set. And even if you have like some markets and war and all these things going around, even if there's some bit of turbulence, we will be very safe because we have enough gas in the tank with 18% capital adequacy.
So, Mr. Vaidyanathan, the fact that you've just done a small round of capital raise, do you think you've just raised capital because capital was available and it was there on the tap, or you genuinely need capital? Because the growth right now is so strong that even if you plow back your profit, you really genuinely don't need capital.
It's not only because the markets are giving, which they are today. The good news is that, like I said, in our case, when we wanted capital, we touched the market, we got 3,000 crores. So, and so markets have confidence in us, for which I'm really grateful to the markets. The more important thing is that as a well-governed bank, to be overcapitalized is a good thing, and it gives gives us, our board, our risk management committee, it gives a lot of comfort to our board. Our board is a very conservative board, and they just want to be sitting on a lot of capital all the time, and I feel the same way as well.
So if you have to divide, let's say, the trajectory of the bank in three pockets: short term, when I say 1 to 2 years; medium term, 3 to 5 years; and long term, which is 5 years plus. Can you give us a sense of the roadmap? Short term, medium term, long term.
A very good question. Let me talk long first. In terms of long, I once did a quick work about the Indian market on the three businesses: retail business, MSME business, and the agricultural business, rural business. This market today is $1 trillion. If we just did a reasonable assumption of growth, in 20 years, it should be $15 trillion. And when we did our growth, you don't have to take my word for it, but we guessed it at, say, 20% for 20 years. It could be 18 also, it could be 15 also. I want to leave the caveats open. But if we did that, we found that, the loan book could be, any number. I don't want to say the number also. It looks really so high. It looks like a multiple of 35 plus. So that's the kind of growth opportunity available. So we are always focused on that. I know quarter numbers are good, but we don't get excited by that because our eyes are there. In the medium run, I'd say that we should focus upon building the bank in a stable manner, manage all these headwinds and economic situations, and post a decent return on equity and return on assets. In the short run, we should be very, very, very focused on managing our credit quality, and particularly with the messages going around in the environment, etc., global environment, not India. We should be very particular on asset quality.
But given that right now Reserve Bank of India once again has raised concerns about unsecured loans, as in banker, do you think there is a concern coming there? I mean, is there a bomb ticking somewhere, or right now you don't see any problem whatsoever, at least on the unsecured part?
What we have done is we have tightened all our credit norms. We don't want to get complacent from the fact that we've never had a credit problem. For 13 years, our gross NPA has been 2%, net has been 1%, and credit cost has been very low. We take confidence from that, but we don't want to be complacent. So we have tightened all our norms just to be extra safe, because we heed the concerns, and they are important concerns.
That's IDFC's first Vaidyanathan chatting with us and talking about how their earnings are likely to pan out going forward, and of course what the quarter went by was like.